What's going on, everybody? Today on the Austin Smith Real Estate Podcast, and this one's an interesting one. Two reasons why. One, we're bringing on two lenders, ironically, that we're going to be diving into the four things that you need in order to buy your next home or buy your first home. This is an episode that's specifically for the first-time home buyers. And today's guest, he's been in the game for 20 years. All right. So he has a lot of experience. So he's going to be peeling back the curtain on what he's seeing being effective in the market, matching up which type of loan products that is perfect for you as the consumer, and making sure that you're able to stay under budget while getting the home of your dreams. He's done a ton of loans, residential, multifamily. He even does a little bit of investing on the side, which we'll get to a chance to talk about later in the future. And currently the branch manager at MLB Mortgage. Ladies and gentlemen, I'd like to introduce you to Michael Santos. Mike, thank you so much for taking the time to come on the show today.
Thank you so much, Austin. Thank you, John. Thank you, Austin. Thank you for being here. Thank you for inviting me here. Really love to educate people out there on home ownership and really give out the facts, right? I always say it's all about educating first. Once you know the facts, you can make an educated decision, and it's that much better. It's scary when you make decisions that you don't really know why you're making them, right? So,
especially on a couple $100,000 of a purchase.
Absolutely.
I want to point out one thing before we dive into this. We're doing a pilot episode, ladies and gentlemen, for my colleague here, Jonathan, who's going to be serving as my co-host. I would love to see how the episodes run with him. This is a guest that Jonathan wanted to definitely bring on the podcast just to be able to tap into his expertise. So be on the lookout for future episodes. We'll see how this goes, but I would love to get your feedback. But I'm more than confident. Be sure to check out our episode as well. And let's dive into this. Mike, how did you get started? Obviously, you weren't, born straight into real estate, or maybe your family was. But how did you get into the lending industry?
Yeah, so no, my family was not in the industry at all. I got into the industry, I stumbled upon it because as many young people, when they graduate high school and they finish college, they have to find their own path. They have to find what they're passionate about. And I got to tell you, as soon as I graduated high school, I knew that I was on a quest to find something that I love to do. I bounced around. I had, all different types of jobs. And, one morning I was waking up like I worked construction in 18, 19, 20 years old. And my mom, I grew up with a single mom. So, that kind of resonates through my hustle and my motivation. She looked at me, she says, "Mike, you look miserable." I said, "Well, it's 5 a.m. and I know that I'm about to go work outside and break, I know I'm about to go bust my butt and do this." And nothing against, being in construction. I just knew it wasn't for me, right? I wasn't happy doing it. So she brought up a cousin of mine, and at the time he's retired now, but at the time he owned a mortgage company. And she says, go speak to your cousin. And I went to go speak to him. I had no idea what a mortgage was. I was 20 years old. I think it was a huge lesson the way he brought me into the business, because for a year straight, he didn't allow me to earn any money. For a year straight, he told me, keep your daytime job, but at 4 or 5 o'clock when you get off work, you come check me out at my office. And at the time it was in Newark, right in the Broad Street, Ferry Street area, where kind of right off of McCorda Highway. And he says, you got to come meet me, and you're going to come with me to appointments. And back then, this is going back 2000, computers and laptops weren't that popular. So we would go to people's houses and take down mortgage applications and pre-approve them on the spot. I did that for a year straight. On Sundays, he would make me drive to his house, and he would train me and teach me tactics and just how to do numbers and how to break down mortgage payments and program guidelines. And for a year straight, I got to be honest with you, Austin, I got used to not making money off it. And I was working during the day, so I had a paycheck. So I'm like, all right, I guess eventually I might make some, but I'm going to keep doing this part-time. And I'll never forget it. About a year later, he calls me up and he says, "Come up to my house. I want to speak to you." I get to his house. He gives me a $25,000 check. And he says, "I've been saving up money little by little for you, because I know I haven't been paying you for a year straight. And I've been saving up money." And at that time I was 20 years old, 25,000 for a 20-year-old, I was the richest man on
Right,
earth.
right.
I got to tell you, it was the best way. It was the best way I got brought into the business because I didn't chase the money. I wasn't getting paid. So I was like a sponge. And I really listened to the way he practiced one of my favorite words, empathy. He practiced empathy. He always listened to the client. He always stayed quiet and listened to their needs. And for a year straight, again, I didn't get paid. So I was like a sponge. He gave me that check and he says, quit your job in 2 weeks and you're full time. I was a little hesitant and I was like, Tony, you know what? Why don't I just keep the 25 grand? I'll keep working construction. And he's like, no, you're ready. That's it. And that was it. I never looked back. I'm 41 this year. So I've been doing it for 21 years.
That's awesome. Was it easier for you to transition because you had that $25,000 check? Or do you think helping others buying a home was that push that gave you to get into the business?
Right. So, 25,000 was a big help because again, I was growing up with a single mom. My mom couldn't afford to pay my way. If anything, I started paying her way a little bit. Right. So the 25,000 counted a lot. But the other thing that really motivated me was because I wasn't blinded by the commission. I didn't know how a mortgage rep earned money. So I really got taught the right way and to appreciate what the client needs as a first-time home buyer. And those phone calls on a Sunday night because they don't know what the next step is. So yeah, I think the needs of a client needing us, right? It's good to feel needed, right? It feels good to feel needed, especially if we are a true professional in our business and we master our craft. And if we love what we do, we don't mind giving out that education. And I still do that. I mean, I had a conversation with someone this morning for a half hour that right in the beginning, I already knew she didn't qualify, but I still gave her a half hour, 45 minutes of my time. And she turned around, she says, I got to ask you, for whatever reason, she asked me what my last name was. So I was like, my last name is Santos. She's like, you have such great energy. You knew I didn't qualify and you took a half hour of your time on a Friday to school me in. I said, yeah, I love what I do. That's the only thing I can answer is I love what I'm doing. So for me, it's not work, right? So, it was both, John. The 25,000 helped because growing up with a single mom, I didn't have anything else to fall back on. But I think feeling needed by people that were investing in one of their biggest investments of their life, which is a mortgage, that in itself was enough for me. You had me at that. I was like, I'm in,
I agree. I think the transactions go, the closings are that much more rewarding. Yes, like that is when we get paid. And obviously we are doing this to put food on the table and feed the families. But there's just something about like the thank yous. Like there's not, it's so much different than a web order where you get an automatically generated thank you, or you know what I mean, like one of those. But these are like genuine, like thank you so much. Like I remember me and John were just working on a deal where the day of closing, there were some things that were a little bit, out of whack. And obviously these are times where people are probably the most stressed and have the most amount of like anxiety and want to make sure things go okay. And I think it's those times where the deal pulls in and they're like so grateful that you were able to put things together, and you're always going to be, remembered for that, in their memory, and it goes so much farther. So I definitely agree on that, just as far as just the education, being a resource, being someone of value, and just being someone that doesn't always have we're not attorneys, so we don't bill by the hour, you know what I mean? And we're not just here to just run up a tab or anything like that. We're here to provide value. So that's an excellent point. So let's dive into this. All right. So you've got up to this point, 20 years in the game, you've seen it all. And now in 2020, which you've never seen anything like 2020 before, none of us have, and all the adjustments and things that had to have happened in order to keep the mortgage industry continuing to lend. The 4 things that somebody needs in order to start their home buying journey. It starts with the money. Let's start with number 1. Let's talk about the credit. Let's talk about the credit, debt to income ratio. Break that down for us. What does a person need if they're looking at their finances? What do they need in order to be pre-approved for their first home?
Yeah. So, I mean, great question. And I love diving deep into it because that's why our listeners are listening. They want to know facts. They want to know, how do I get there? So, there is no early time. There is no, so when should I get started? As soon as you think of buying a home, you should get started. Even if you want to buy a house in a year, there's no better time than now. Why? Because it allows you to set everything up. Because a year is right down the line. 6 months is right down the line. So, the first thing you want to do is sit down with a professional like myself or John and say, hey, run my credit. Now, me and John work a little bit differently in regard to credit is like a report card, guys. You can get A's and B's, you can get F's, you can go back to A's and B's. It's not something that's etched in stone. It's not something that can't be changed. And it's not something that people should be embarrassed of. It's a credit. You have good credit, you have bad credit. So credit is definitely one of the most important things, but we typically look at the income first, Austin, because income, you either have it or you don't.
Interesting. Okay. So number one, would you say that that is the most important thing?
I would say income, income.
Okay.
You don't, I get these questions a lot. I'll get somebody that calls me and says, hey, I got impeccable credit, but I don't really show any money on my tax. Unfortunately, I can't, I wish I could, but I can't help that person.
Mm-hmm.
Every mortgage company now, there's every loan, like an FHA loan or a conventional loan, there's something called full documentation. That means that you have to show as tax returns, W-2s, pay stubs, enough to qualify for the loan. So I always give people this analogy. If you come to me with bad credit, with good income, I can help you. If you come to me with good income, with no, good credit, but with no income, I can't help you because you don't have the income, and it might take you 2 years. So you're talking about way down the line, as opposed to fixing someone's credit, guiding them through the way of paying this off or paying that off. Like maybe not having a lease and having a finance card, right? Paying that off before you start getting the mortgage. So things like that are definitely fixable. We can fix those things. So the first thing is income. We look at your income. So what do we need? Well, it all depends on your job. If you just graduated college and you become, I don't know, a nurse or an accountant, then all we're going to need is your college transcripts and your first pay stub, believe it or not. You don't have to go back 2 years. Because believe it or not, with a college graduate, your transcripts count as income. It counts as employment. So it all depends on the person. If you just got a bachelor's degree and now you become a teacher, you don't have to wait 2 years. All you have to give me is your recent pay stub or your offer letter with the offer that you're getting from the school. So in some cases, you don't have to go back 2 years in income, but we do have to know what you were doing for the last 2 years. I was going to school. I took some time off. I went to Lincoln Tech. I went to Rutgers. I got certified. So that's the income. Now, if you just say, hey, I've been working construction, that we need 2 years. If there's no background behind it, we need 2 years of income. If you're working as a manager at Walmart, we need 2 years of income. Things like that. If you're self-employed, 100%, Austin, you need 2 years of tax returns if you're self-employed. Self-employed income can be a little bit more complex. You really got to know what you're doing because, believe it or not, there's things that you can add back towards the income of a self-employed borrower that can make his qualification a little bit higher. So you really do need experience with reading tax returns. If let's say the self-employed income is on a K1 because they're 50-50, partners with that company, that can change the a little bit because they can say, hey, I showed 100,000 last year. Well, your company showed 100,000, but you're 50-50 partners with this company. So what exactly did you show? So being self-employed, whoever is listening out there, being self-employed, the time is right now to see if you qualify for something. Because if we have to be creative with your tax return for the following year, it's good to know early in the game.
How about if someone is going from self-employed to a W-2 job? How long do they have to wait?
Great question. So if you're self-employed and you say, I work for, I'm just going to use an example. I'm a truck driver and I work for a company and, I drive their trucks. I'm going to reverse that. If you are self-employed and you own your own trucking company and then you say, you know what, I don't want to be self-employed anymore. I want to go drive a truck for Costco. Let's just say you can have, I believe it's 3 months or maybe sometimes even a month, depending on the length of employment prior to that. And you can literally hop from being self-employed to a wage earner immediately. And we can give you credit for that W-2 income, that on the books income, which is working for a big company. Now, John, you're probably going to ask me, what if it's reversed? Right? If it's reversed, that's an issue. If you work at Costco driving their trucks and you say, you know what, I'm done working for the man, I want to go open up my own business, you need 2 years of having your business open. That's an etched in stone guideline. There is no flexibility with that.
But how about contracts? Like individuals that are on contract. So for example, but let's say, and I'm not the individual that's on a 6-month contract. Let me understand that. But what if they're a consultant and they just landed a contract with, a Fortune 500 company, or even just, a mom and pop store, and they're on for 2 years and they're on contract. Can you use that as income going forward? Like, is there a threshold where a contract can kind of count as full-time employment, or are you going to consider that, kind of self-employed or
well,
that type of?
Yeah, I mean, so it's a twofold answer. The question would be that contract, how are they paying you? If they're paying you on a personal check and it's your responsibility to file tax returns later on, then we can't use that income until you declare it. Because let's face it, if I write you out personal checks that add up to $100,000 at the end of the year, you're not going to tell the government you made $100,000 because you really didn't. You have expenses. I had to buy tires. I had to get the oil change on my truck. You're going to have expenses. So if they pay you on a W-2, no problem. We can use that income immediately right now. If they pay you on a personal check and it's your responsibility to file your tax returns at the end of the year, 2 years you have to wait.
Gotcha.
Until you have to wait 2 years until you have complete 2-year tax returns. Now, there's a little loophole to that guideline.
I like loopholes.
Yes, there is a little loophole. If you can prove that you're self-employed for 5 years, you might get away with only showing 1 year tax return. That makes sense? Meaning this, let's say I opened up my company 5 years ago and I can show it and prove it with a formation document, right? You know how you get the LLC and it says this was formatted back in 2015? If you show me that and you say, listen, I've been open for 5 years, but my tax returns, I just kind of really didn't focus on my business. I showed 20 grand every year, except for 2019. I showed 100. I can probably get you approved just showing that 100 grand 1 year. If you can prove that you had it for 5. That's a little bit of a loophole. A lot of loan officers get scared to kind of use it, but what we do right up front, and Jonathan can swear by this, when we're a little iffy about the loan, we're not going to trust ourselves. Even though I got 20 years experience, John's he's been shoulder to shoulder with me the last couple of years, so he's got a lot of experience too. We're going to run it through DU, which is the desktop underwriting engine. And I got to tell you, Austin, sometimes we'll run it through DU, and me and John look at each other and we're like, wow, look at that. They only asked for 1 tax return. They only asked for 30 days bank statements versus 60 days bank statements. So it's really like we got to do a lot of heavy lifting up front for our clients without getting paid. And I'm okay with that because it's really going to make the process that much easier down the line. And you as a realtor are going to trust us more. You're going to say, if they tell me it's bond, it's bond. It's going to go through. So we don't wing it here. When we got quirky situations like that, and I want everyone to know out there that's listening, if we tell you that you're pre-approved, you're pre-approved. It's the real deal. It's not these horror stories that you hear out there. Like I heard this morning, somebody showed me a pre-approval for $400,000. I kid you not. This is at 8 a.m. in the morning. The realtor showed me the pre-approval. It came from a Federal Reserve Bank. I said, well, first red flag. Nothing against that, but first red flag. I said, you know what? I said, Suzette, get me in touch with the client. Let me look at their tax returns. I kid you not, guys. They were pre-approved for $320, not $400. The realtor Suzette was like, Mike, that's a game changer. And I said, you want me to lie to you? You don't, right? That's why you came to me. They weren't approved for $400,000. The guy read the income wrong. Just didn't. So again, that's why I say income is imperative. If you make a mistake on income up front, Austin, you might not be able to come out of it later. Because how are you going to look to a borrower at the 11th hour and say, hey, by the way, you need a cosigner? Cosigner? I'm going to close in 2 weeks. Not good. So we really focus on the income. So it's really important to know those numbers.
Oh.
And that's why it's good to do all the legwork up front. You need a great mortgage officer that does the legwork up front. And I'm glad that you do that as well and taught me to do it as well.
We have to, because listen, the name of the game for us is we have to make our realtors look good because they refer us. That's number one. The realtor are client first, right? Because they tell the borrower, you guys are on the front line as a realtor. So for you to say mine and Jonathan's name out of your mouth, that hits home for us, because it's like, whoa, they're referring us to a client that's giving him business. So the first thing is making Austin look good. And then the second thing is making sure that the borrower is never confused, never has any questions unanswered, and knows exactly where they stand with their monthly payment, exactly what that pre-approval means. Because I can't tell you how many times we'll issue a pre-approval and you can tell it in their eyes. They're like, oh, I'm approved for 300. What does that mean monthly? Exactly. You don't know what that means monthly. So the $1 million question that me and John always ask is, forget how much we're going to pre-approve for. How much are you comfortable paying per month? And that number, we work that number backwards. And I'll tell you what happens. Two things happen. Either it's dead on spot and it's like, it's literally parallel to what you're looking at, or me and John have to knock reality into them. Because sometimes they'll look at us and they'll say, I want to pay $1,500 a month on a mortgage. And I say, ma'am, sir, that's what you're paying in rent. You cannot assume or think you're going to be paying the same on a mortgage payment than you are in rent. And let me use this analogy. When you go finance a car, is your payment higher than a lease payment? Typically, yes, because you're going to own that car. It's an asset now. So when you finance a car, just like when you get a mortgage, you're going to own something, that payment's going to be higher. If you go rent a home, your payment's going to be lower, just like you can lease a nice car at a very small amount. So it's really important for us to put that reality into them, because then they start thinking, they're like, oh, wow, you know what? I can go up to 2,300. Let's go up to 2,300, Mike, because 1,500 a month, let's face it, guys, that's equivalent to like, I don't know, 180,000.
Pretty much so.
Yeah, that's not realistic in today's market.
Right.
You really dive in deep with that when you send this to us.
Yeah, I think it's a good time to go on to the next step. I know we touched base early on regarding credit, but we swigged a little bit over to income. Let's touch base on the very next important step, which is credit. Talk to us about credit.
So credit. So right away, we run credit. We run credit with all three bureaus, which is a hard pull. We do have the ability. Now, a hard pull is that we run credit with all three bureaus. That's considered a hard pull. And, you know, a lot of clients say, well, is that going to lower my FICO score? It might impact your FICO score slightly, but not enough where it's going to make or break the deal. And at the end of the day, what choice do we have? You have to run credit, right? So we run credit, all three bureaus come out, and we choose the middle score. You know, so the easiest, you know, because sometimes, well, do you use a FICO score? Do you use this score? We use the average. So whatever the average is, if it's a 620, 640, 630, we're going to go with the 630. That's the average. That's not the high. It's not the low. It's the middle. So we run credit. We look at your liabilities. Guys, liabilities are very important. Student loans can be a deal breaker. A car lease payment can be a deal breaker. Credit cards that are maxed out can be a deal breaker. So when we run credit, we don't just give you the credit score. We're going to really look at every single page. We're going to look at your collections accounts. And the one point that I want to make with credit is the worst thing somebody can do is try to fix their credit before they come see us. Don't do that. If we're your goal, right? You want to borrow money from us. Let us run your credit first. Do not go get outside opinions. Do not try to take it upon yourself. I beg you, do not do that. Let us run your credit and analyze it and say, in order for you to buy a house, you got to do A, B, C, and D. And we own software internally here at my company, at our company, that runs algorithms on your credit. Tells me what you can be doing better, tells me what you're doing wrong. And if you have the ability to pay things off, we can literally give you the score impact. Jonathan has used it numerous times. So again, in regards to credit, don't take it upon yourself and start paying off things. Let us run your credit and give you a roadmap on what you need to do. Other than that, I mean, you know, most people know everyone has a credit report. A lot of people get the freecreditreport.com or Credit Karma. What I can say about Credit Karma, guys, is the score is usually higher on Credit Karma than us. And I'm going to, You probably heard that before, huh, Austin?
I was just looking at my credit score, like, oh, okay, that's what I'm talking about. And then John read did my credit for our current purchase, and I was like, what? That's not what Credit Karma said. Like, what are you talking about?
And the reason for that, there's a good reason for that. The reason for that is because Credit Karma is not lending you money. That's the reason. Credit Karma is Credit Karma, don't get me wrong, Credit Karma is reporting accurate information all day long, absolutely. But their scoring model is a lot less strict than a financial institution, meaning that we're not gonna want you to be over 10% of your credit card limit, where Credit Karma might say 50% is fine because they're not lending you money. So that's the big difference. So really the key of the credit report is, let me hook up with John, let me hook up with Mike, and let me get my credit score ran immediately. So they can give me basically a diagnostic look at my credit report. And we're gonna tell you what you need to do.
I had one, to piggyback off, I had one individual that, similar, she unfortunately thought she was doing herself a favor and her family a favor by paying off all these cards and things like that, and wound up paying, overpaying, or, just, she didn't have to pay off all the cards. Like she could have kept more of that money in her pocket. Is it beneficial long-term financially? Absolutely. But, she didn't have to do it all at once, and she could have used that money for anything else. Or, so yes, that makes perfect sense. Real quick, just before we go into the third one, the third step, which is the assets, the money, like what do you need in order to close, right? Like what is it? Like, cause I feel like it's a mystery sometimes, and people usually wonder like, well, what am I bringing to closing? So before we go into that third step, just break down really quickly the debt to income ratio, just as far as what lenders are looking for as they combine income and credit, and focusing on the debt part, and just to run some numbers that way.
Yep. So I'm going to give you like the most simple terms, the way I got trained. So mortgage companies calculate two ratios, a front ratio and a back ratio. The front ratio is your gross monthly income divided by your anticipated mortgage payment. So very simple. I make $50,000 a year. Divide that by 12. Remember, gross, not net, gross. That monthly payment, that monthly income that you have, if your mortgage payment came out to $2,000, we can already do it in our head. That's a 50 front ratio. You make $4,000 a month. Your mortgage payment's $2,000 a month. 50% front ratio, you wouldn't get approved. The max ratio for an FHA loan, the front is 46%, which means the government allows you to have a mortgage payment that's 46% of your gross monthly income. That's FHA. Conventional, 44.9. So that's pretty simple. So, Mike, I make 60 grand a year. How high can I go on a mortgage? You divide 60 grand, you divide 60,000 by 12, take 46% of that. That's your max mortgage payment. It's that simple. If it's going conventional, you take 44.9 of that. That's your max mortgage payment. Now that's your front ratio. That's the easy one. And I got to be honest, a lot of people say, oh, the front ratio is important, but the back one's the most important. Yes and no. For me, the front ratio is more important because your debt, you can pay off. You can pay off your debt. And then that front ratio is going to be super affordable. When I see a very high front ratio, I look at it like this. Even if that guy pays all his debt off, he's still got a high front ratio. It's still 46. So can you really afford the home? Right? And we got to, and guys, I think it's safe to say that people sometimes get in over their heads, right? Oh my God, I bought this house. I thought I qualified. Mike and John told me, I qualified. I was on the edge of not qualifying. And you know what I did? Instead of saving money and cutting back on things, I got in over on my head. I started going out more. I bought a car. So I really get concerned when I see a front ratio that's high, because when a front ratio is low, it means you really could afford the mortgage pretty easily. You just got a lot of debt that you can pay off. So that's the front ratio. The front ratio is very simple. It's your monthly income divided by your mortgage payment. Now, the back ratio is your monthly income, again, divided by your mortgage payment plus your monthly debt.
on your credit report, not in your personal life, not haircuts, getting your nails done, only what's on your credit report. Well, Mike, what's on my credit report? Revolving debt, credit card debt, secured debt like a car payment, a mortgage, student loans. That's a deal breaker nowadays. Things like that. That's your back ratio. The way you calculate it is you take that mortgage payment, you add the minimum payments of your credit report, and then you divide it by your monthly income. And typically that ratio on an FHA deal cannot go over 56, and with conventional, it cannot go over 49. So as you can see, conventional is a little bit more conservative. You can't borrow as much money going conventional. Plus the credit score requirements are a little bit more strict, right? FHA is the most lenient. You know, it really is the granddaddy program of the first-time home buyer. It really, I mean, where else in the world, and there is nowhere else in the world, can you buy a 4-family house with 3.5% down? It's amazing. So
one question to talk about the debt. So a lot of people have gone into deferment with their student loans, maybe their car payments, and people think they have zero debt for their back ratio. What's the real story behind that? A lot of people that are in deferment now.
So deferment, guys, you can have everything deferred, right? But if you go apply for a loan, you got to be totally out of deferment. So if you're not looking for a mortgage, defer everything for now. Absolutely. But if you are looking to get a loan, you can't be in deferment, obviously, if you have a mortgage, because if you're not paying your mortgage that you have now, they're not going to lend you money for a new one. And if you're in deferment with car payments or student loans, it's not to say that we won't lend you money, but we're gonna ask you some questions and say, hey, you know, why are you deferring? Well, you know, you can't just say I thought it was free money, because then we got to. What I'm saying is, you can back out of that though. Like we can tell you, like I have someone that was in deferment. They said, Mike, I'm going to stop everything. I'm going to get off it. I'm going to pay everything off, and then I'm going to apply for the loan. And you're fine. There is no grace period, just so you guys know. There's no like, oh, now you got to wait a year. If you're in deferment because of COVID, get out of deferment, you can apply for a mortgage. But if you are in deferment, you cannot apply for a mortgage, like at the same time.
One last question before we move on to assets. What's the minimum score needed to buy a home for conventional and for FHA?
So across the board right now, it's 620. So conventional, 620, FHA, 620.
Perfect. So now that people know, okay, now I know what credit score I need to be at. I understand a little bit how the lender will calculate how much mortgage I can afford. Now, you know, so I'm good with that. I have great income. I have solid credit, and I'm ready to, I found this house that I want to submit an offer on. So far, my agent told me that I'm definitely within the budget that, you know, we spoke about. What's the money now that I'm in the transaction? My simple question for all, you know, home buyers is, how much is this thing going to cost me? I know where my down payment's going to be. I know where my monthly mortgage is going to be, because I told you where I wanted to be as far as my budget. But how down payment, closing costs, I thought they were the same. Turns out they're not. What the hell is a seller's concession? How much is this thing going to cost me out of pocket, whether I'm doing FHA or conventional? And the reason why I ask is because if everyone was able to put down 20%, then we would have no reason to have these first-time homebuyer programs, because it would just be 20% down and that's it. But because it's not, we're first-time homebuyer options down, conventional, FHA. Mike, how much is this thing going to cost out of pocket?
Yeah, you know, I get that thrown at me all the time. Like, give me like a round number. Austin, you know what the round number is? I got to be honest with you. And it goes for like any house that's over 250 and higher, right? So if a house is like 150, 180, 200, then maybe this number is going to be a little bit lower. But you know what the rule of thumb is? And it's like, it never lies. As long as you can roll in closing costs, seller's concession, right? As long as you can roll those in, typically you're going to need anywhere from 10 to 15,000. That's the number. It might not be 10, it might be 11, it might not be 15, it might be 14, but 10 to 15,000 is what you're going to need. It's what you're going to need for down payment, an inspection. You're going to do probably a home inspection, an appraisal, right? Because that right there is like $1,000. And then you're also going to have to get homeowners insurance, which is like another $1,000. So the 3.5%, which typically adds up to about 10 grand, right? Plus 1,000 here, 1,000 there, it's anywhere from 10 to 15,000. Now, if you have to pay for your closing costs, typically closing costs are, and this number really never lies either. It's anywhere from 8, 12, unless you go really high on taxes, maybe 15. But 8 to 12,000 bucks is your closing cost. Always, always, always. I also want to break down though, because a lot of people have the misconception about closing costs, and they say, "Oh my God, $12,000 for cost?" No, closing costs are probably 5, 6, 7. Your escrows and your prepaids, which is your taxes paid in advance, your insurance paid in advance, and a lot of people don't know that. When you buy a house, you're going to skip a month to 2 months without a mortgage payment. So it's almost like I love using analogies, right? Because it kind of explains it to people. It's like when you lease an apartment. When you go lease an apartment, the landlord's going to ask you for a month and a half security plus first month's rent. That's not a cost. That's your money, right? First month's rent goes towards your first month's rent. Your security deposit stays there until you move out. It's the same thing with a home. You have escrows and prepaids. The government makes you pay your taxes in advance 3 months, your insurance in advance a couple months, and your mortgage insurance, if you have it, a couple months in advance, plus the interest per diem, which is depending on what time of the month you close, and your next month's mortgage payment. So that is typically around 3,000-4,000 bucks. So when people say, "Oh, so where does that money go?" Well, some of it's towards your first and second month's mortgage payment, because you're not going to have one. And the rest of that money sits in an escrow account. Every month you get your mortgage statement, it says escrow balance. That's your money. Whenever you sell the home, whenever you refinance, you get that money back. So a lot of people need to know that there's 2 categories with closing costs. There's the true cost, the true fees that you'll never get back, that are tax deductible, by the way. There's those true costs, and then there's escrows and prepaids. When you add those 2 up, typically around 10, 12,000 bucks.
Gotcha.
Let's talk about seller's concession. I know we briefly touched on it, but explain what seller's concession to our viewers.
So seller's concession is when the seller agrees to let you inflate the price of the house to roll in and finance your closing cost. Now, super popular, super worth it. And even if you have the money, it's still worth it. Because I want to give you guys some numbers that are just pretty cool. For every $10,000 on a mortgage, right now with today's rates being so low, it's like $45 a month extra on your mortgage payment. So you got to think to yourself, should I keep $10,000 in my bank account, or should I roll in my closing costs and just have my payment go up 45 bucks? 9 times out of 10, even if you have the money, you're going to say, I'd rather keep the money in my bank account. The problem, and I'm pretty sure Austin can relate to this, the problem is a lot of sellers and a lot of listing agents right now are afraid of seller's concession because of appraisal values. Because don't forget, even though that money's not going to the seller, it's going towards your closing cost, the house still has to appraise for that amount, for what you're paying for it, plus your closing costs. So if you go see a house with Austin and you say, "Austin, I want to give them $350, but I want to roll in my closing costs." So the house doesn't have to appraise for $350, has to appraise for $360. So that's where kind of like listing agents are looking at borrowers and they're saying, "Well, you're weak because you gotta roll in closing costs." And here's how I kind of pitch it to my realtors. Realtors, it's all about delivery, right? Everything in life sometimes is about delivery. It's how did you deliver the message that person got upset? How did that person deliver the message that they were okay with it? Deliver it in a way that it sounds positive. Like, "Hey, my clients have the money for closing costs, but they want to see if they get approved for it and take advantage of first-time homebuyer incentives." Now, if the house doesn't appraise for that extra 10, my client has the extra 10. Now, we have to make sure that the client has the extra 10. We can't lie about that because then it might blow up in our face.
We got the extra 10. We'll find out later, but we got the extra 10. If anything, we can get out an attorney review, but we for right now we got the extra 10. We'll make it work.
And that's another thing. Sometimes I'll tell the realtor, I'll say, listen, no need to talk about closing costs now. Talk about them during attorney review. There you go. So, because who do we work for? We work for the borrower. We work for the client. We work for the buyer. The buyer is our client. We have to make sure they get the best deal in the world. That's why I always tell people, no offense to listing agents. I love every agent out there. But if you're a buyer, should you call the sign on the lawn or should you call Austin, your realtor, buyer's agent? Whose interest does the listing agent have? The buyer or the seller? The seller. That's their client. So I always tell Mike, I say, you got to get yourself a bull. You got to get yourself a buyer's agent that's going to fight for you. That's going to try to get you the best deal possible.
Before Jonathan brings us into the last step, which honestly is one that is definitely more important. Like I know we kind of numbered them in most importance, but like all of these are definitely important. But before Jonathan brings us into that, for everyone that's listening and everything that Mike just went over just now, for everyone that's in New Jersey, that's a first-time home buyer, you're usually going to see those numbers. Now, I know we have some listeners in other states for sure. So I'll have Mike just break down where he's getting those numbers for New Jersey. And then so that way you're able to take that into any market that you're in. But for everyone that's listening from New Jersey, everything that Mike just ran, which is, to Mike's point, between maybe 200 and about maybe a 450 purchase price, average high New Jersey taxes, you're looking at between 10 and 15. And to Mike's point, with your closing costs, you're definitely going to be looking towards 8 to 12K. I don't think I've seen anything above 12 unless the taxes were absurd. They were 15, 16 grand because, like Mike said, your prepaid is going to be higher because of those taxes. But Mike, real quick, just give us something to work, as far as what is the down payment for FHA, conventional, just for anybody that's anywhere else in the country.
Yeah, so here's a myth. A lot of people think that the lowest down payment requirement is FHA. Quite the contrary. The lowest down payment requirement is through conventional. John has done this program a couple of times, and so have I. So conventional, if you qualify, there's a program that allows you to buy with 3% down. 3, not 3.5, not 5, 3% down. And it is a phenomenal program. You need a high credit score. You can roll in the closing cost. You got to take a first-time home buyer course online, but 3% down with a minimized mortgage insurance premium. So that's conventional. So conventional typically is 3%. Actually, I want to say that's a very unique program, but typically conventional is 5% down. They do have that program. That's 3%. We have to see if you qualify for it. That's conventional. With FHA, 3.5% down is your minimum credit score. You can go up higher, but that's the minimum, 3.5% down. So you got conventional that does 5% and 3% down. You got FHA that does 3.5% down. You have VA, veteran financing, right? For all the veterans out there, 100% financing with no mortgage insurance. That's a VA loan, right? And USDA is also, USDA, for anybody that's listening that doesn't know, USDA is property that's in rural areas, acres, farmland. Jonathan has some experience with that too, but that's also 100% financing. So let's recap. FHA, 3.5% down. Conventional, 5%. And if you qualify, 3%. That's a very unique program. If you're a veteran, 100% financing. If you're buying a farm or a property that has a ton of acreage in a rural area, that's also 100% financing. And then there's also something called a 203K, which is a rehab loan. It's basically a program that allows you to buy a house that's in very poor condition. We lend you the money to buy the house, and we lend you the money to fix the house. That's also 3.5% down, and that's through FHA.
And the one question that I asked was, As far as closing costs, like do you use a certain formula that, I know sometimes people say between 2 and 5% of the purchase price. Have you seen that there is a particular number that works that somebody, who's not dealing with New Jersey can use and apply just to get an idea of where their closing costs are going to be?
Yeah, I mean, if you're in New Jersey, I've always seen the number 4% of your purchase price, and you said 3 to 5, so think about 4 is right in the middle, right?
Mm-hmm.
So for New Jersey, 4%. If there's people out of state watching this, the closing cost, the true closing costs, are still going to be almost the same, because let's face it, mortgage companies have a commitment fee of $995, typically, like right under $1,000, but it's a standard fee. They have an application fee, standard fee, $395. And then, your attorney, if you are using an attorney in the state of New Jersey, you do not, I repeat, you do not need an attorney in the state of New Jersey. Actually, in South Jersey, no one uses attorneys. It's typically Central Jersey and North Jersey, we use attorneys. In New York, you need an attorney. But for other parts of the country, your closing costs are probably going to be lower because of property taxes. Let's face it, New Jersey has very high property taxes. And remember what Austin said, what you said, Austin, 3 months, 4 months in property taxes. Think about it. If they're $800 a month, 8 times 3, that's a lot already. That's $3-4 grand you're going to be paying just in escrow. So, for everyone that's listening that's outside of New Jersey, I would think your closing costs might be a little bit lower than ours, other than New York. New York is the highest. New York has by far the highest closing costs because they have even New Jersey has the mansion tax, meaning that if you're getting a house for more than $1 million or a certain number, you get taxed on that. With New York, what really hurts is that you need an attorney and you have to pay for the bank's attorney as well, because every lender needs an attorney in New York to do a transaction, and the buyer needs an attorney and the seller needs an attorney. That's why. Hey, John, am I licensed in New York?
No.
I don't know enough about it. And, I was taught at a very young age, concentrate on what you're good at in your own neighborhood and dominate in that area. So, but yeah, closing costs, they vary, but, I think 8 to 12 grand is a good estimate.
Awesome.
I think we touched on all the main steps. I know the first one was income. The second one was credit. Third one was assets, down payment, closing costs. We briefly touched on the fourth one, which is monthly mortgage payments. We touched base on where people want to be. I think we could probably move on to the next is what's next? What's like next step for you? What's your next goal?
Well, I mean, we want to talk one more thing I wanted to bring about the assets. Guys, with FHA, remember, a gift is available. You can get a gift from a relative. That's a beautiful thing.
And what does that mean? You can get a gift? Like you can someone's going to wrap a present for you. They're going to deliver the keys in a box. What do you mean a gift? What's gifted?
I'm going to be very transparent here. Let's face it. It's usually not a gift. It's usually a loan, right? But in my eyes, it's a gift. Now, off the record, this is off the record. If you are self-employed and let's say you have money under your bed or in a closet, mattress money, and it's legitimate money. You made the money in your business, but let's say you just don't trust the banking institutions here in America. A lot of people are like that nowadays, especially with what's going on. They say, no, I don't want to keep my money in the bank. I'm getting to be like that where I want to keep my money in my house in a safe, right? So if you have a situation like that, how are you going to use that as a down payment? The only way you can use it by getting a gift from a relative. And what goes on behind the scenes, if they give the money back to their relative, I don't know about it. I don't want to know about it. But that's how a gift works. It's called a gift, Austin, because it's legitimately a relative that says, hey, Jonathan, I want to help you buy this house. It's your first home. I'm going to give you a gift of $10,000. Now, between us three and whoever's listening right now, typically that $10,000 goes back to that relative somehow. I don't know how, but it does eventually, right? So it's really not a gift, but it is supposed to be a gift, guys. It really is. It's not supposed to be a loan. But a gift, yeah, I mean, FHA allows 100% gift, meaning that if you have a relative or a mom or a dad that says, I'm going to give you the down payment and I'm going to give you the closing costs, totally allowable. Totally allowable. Conventional, they don't allow 100% gift unless it's 20% down. So give you an example. If you're putting 5% down on a conventional, you cannot get a gift. That has to be your money. If you're putting 10% down, 5% has to be your own money. The other 5% can be a gift. So as you can see, conventional is more conservative than FHA. FHA is more lenient about certain things. So yeah, I mean, I wanted to go over that because a lot of people, you know, I get a lot of people that have bank accounts and have the money in there, but have large deposits, and it really doesn't get touched on up front. But, you know, assets and savings and how to save up for a home, I think needs to be spoken about a little bit more, right? Because you know you have a job, or else you wouldn't apply for a loan. You know you have a credit score, right? Maybe you want to fix it, but how do I save, Mike? How do I get to that 15,000? Can I use a 401k? Can I get a gift from mom and dad? Can I refinance one of my properties that I own and take money out of there and buy another one? And the answer to all those questions is yes. You can use a 401k. You can get a gift from mom and dad. You can refinance one of your properties, take money out, buy another one. You just can't use cash. If you have large deposits that are not traceable, right? There's something called, we like to prove where it came from. If you can't prove where it came from, that could be an issue.
Gotcha. And even proof just has to be a paper trail. Even if you were like, hey, I saved this up, or maybe, you know, at one point I was doing it was a challenge where, like, you know, you save $1, you know, every week that goes by, you save that number, you know, as far as, you know, money. So like the first week of the year, you saved $1. The second week you save $2, third, you know, X, Y, and Z. But say if somebody did that, you know, that plan OD wild style, and then it was, you know, $100, $200, and then at the end of the year, they're sitting on, I don't know, $20,000. And they have it tucked away. They just did it because that's the way that they were going to be able to adhere to the discipline to save their goal. So it comes time to buy. They take this cash. They're like, I know the bank needs to see it, or the lender. I put it in my bank account. Like, hey, Mike, you saw me. You coached me as far as since the very beginning, like you saw, and this was just me talking to you as a friend, that I was going to do the savings plan to save up. So now I have this money in the bank. I can't use that at all.
Well, if you put it all in one shot, I'll tell you this, me and John need to see the money in there for at least 30 days.
Okay.
So that's why in the beginning of the session of this call, I said, there is no, how early should I go see John and Mike? There is no date. Come see me today. Come see John now. Because if you have 20 grand, 30 grand in your house, we're not supposed to coach you, but we are human and we want you to become homeowners in a safe, in a good way. So we're going to sit down with you and have an off the record conversation and kind of guide you to where you need to be with that. But yeah, that could be a problem also. And I got to be honest with you, you have 20 grand, you have 20 grand in your home. You can't just go into any bank and say, here's 20,000 cash, and then give me and John a bank statement. If we were coaching you from the beginning, I would have said, hey, put that money little by little in an account, not under your mattress.
Yeah, I remember they were asking me over like $1,700, like $2,500 that I just dropped in there, and it was just like, it was cash, like it was just cash that was laying around. I just happened to throw in, like, where did it come from? Like, it came from my, like, I don't know, wherever the heck I was like working on, or like bartending tips, like way back in the day that I just stacked, like, who knows? But it, you know, but they really wanted to see a paper trail. So,
well, you know, there's something to be said about that, because you're absolutely right. I mean, it's like, well, I don't know. I mean, I had a birthday party and somebody gave me money. Things like that. I mean, a strong letter of explanation, as long as it's not like a lot of money, but like I've had underwriters read a letter and say, to whom it may concern, I used to be a bartender up to about 6 months ago. You know, I was a bartender now, you know, I've been a teacher, and this is just money that I've saved up in the last, I don't know, couple years. Believe it or not, and I think, Jonathan, what's the rule? I think it's a 1% rule, right? Like 1% of your loan amount is allowed to be considered a large deposit in your bank account. And I think the other guideline is you're allowed half of your gross monthly income as a deposit in your bank account, one shot. So there's a little flexibility there. You know what they don't want to see, Austin? They don't want to look at a bank statement and say 5,000 cash, 10,000. They look at that and they're like, whoa, where did you get this money from? But a one-time deposit of, you know, $2 or $3 grand, I think me and John can pull some strings.
Gotcha. As we start our descent here, because the conversation is going really well, and I always usually try to keep a bulk of it in a specific time frame, but just like when it's, when there's a lot of gold and you get into the conversation, it just goes really well. But before we go into the core four, which are the four questions that I ask each and every guest on the podcast, what's next for you? Where are you taking the business? What's do you think you'll still be doing lending 5-10 years from now? Do you want to go into something different? What's your thoughts? Where you want to take it?
Yeah, so I feel like I'm in a really good spot in my career. I've been doing it for 21 years. I don't want to get any bigger. I don't want to hire a bunch of loan officers and salesmen. I really just want to keep a tight crew. Jonathan is my main guy. Quite honestly, it's not because he's on this podcast. He knows it too. I'm pretty sure because he's here every day. He's my main guy. If I can help Jonathan continue to grow, and maybe even help him open up a branch one day if he really wants to, I'm good with that. I don't want to hire a bunch of people just to have a bunch of people around me. I want to just have a nice, solid core team, and I want to be able to offer the best customer service I can, like I've been trying to. And where do I want to go from here? I just want to continue to do mortgages and help people get into homes. I don't want to step away from originating loans. Believe it or not, I still like doing the groundwork. I still like uploading loans. Jonathan knows we're always looking at ratios. We're always looking at credit reports. I don't want to get so big where I step away and I have people do things for me, because it's not that I don't trust anyone else. I like what I'm doing. So, where do I want to go? I want to train more people to care about the business like I do. Don't look at the mortgage and real estate business as a check. It is a career. It's a career that will be very generous to you if you're good to the career. If you're good to the business, it'll be good to you. So I want to keep doing mortgage. I want to keep originating loans, keep building my brand, and I want to help guys like Jonathan to build their own brand and work shoulder to shoulder with me.
Awesome. I think that's a good turnaround to go into the core four. The very first question of the core four we usually ask, Austin asks all his guests, is what's your favorite aspect of real estate?
My favorite aspect of real estate, well, from being a real estate owner, obviously creating true passive income is my favorite. And there's a couple different definitions for passive income. Buying a 4-family home and having to go fix things every weekend and having to go collect rent, it's not true passive income, right? You're working for that income because you're going, you're answering calls. So because I love the mortgage business so much, I've chosen a different path in regards to real estate. I do not buy real estate without partnerships. I do not. I do not own any real estate by myself. Not one property, none of it. Everything is with partnerships because I believe in partnerships. I believe in complementing each other. I believe that if I do financing and I do the mortgages, maybe you're the one that picks up the rent. Maybe you're the one that, fixes things on the weekend. So in regards to real estate, I like true passive income. That's the best thing I like about a true passive income. And I have partners that own real estate with me that I actually pay them out of the rent every month to manage the properties, because that's apart from being my partner, right? So that's what I like about real estate, that true passive income, and obviously the equity. What your money is today is going to be a lot more later on. And I use this analogy. If you put $100,000 in the bank today, it's going to be worth the same in 10 years.
Less.
Right? Or less, right?
Inflation.
If you put $100,000 in real estate, it should be worth a lot more. So that the power of numbers is really what gets me with real estate. Now, the other flip side is where I want to be with the mortgage business, is just keep, again, originating loans and helping people, with home ownership and teaching them about investment properties, because I know a lot about having investments and, what's your rate of return, and I love teaching it. So, it's a great thing. I just, it's hard for me to own property by myself. It really is. I would be.
Why not? That's so interesting. So partnerships, not just because I'm in the position now where, only dealing with 3 properties at the moment, right? So like 10, 3, 6, 9, 9 units to 10, 9 to 10 units, and I'm getting to the point where like I do see myself, and it's not so much like the repairs, like I'm not doing it because it's a quick phone call, right? So it's really easy, but at the same time, like I'm spending a lot of time, not even a lot, it's just like inefficient time. So why not just like a property manager?
Right. So you have to ask yourself, Austin, where do you make the most money? Doing real estate or owning real estate? Now, right now, like the right now money, not later on in life.
Okay.
Probably real estate, right?
Right.
Right. So I would rather pay someone, because what's more valuable, time or money? Time.
Time. Uh-huh.
Because time, you can make money tomorrow, but you can't buy back the time you lost. So in my opinion, that's why it works for me. I would rather take less money per month on rental, but not have to worry about it at all. Have people doing that for me where I can focus my time and energy in the mortgage business, because that's what allows me to buy those properties. That's what allows me to do those ventures. Buying a property and just banking on that rent, $1,000 or $2,000 a month, between me and you, that's not gonna get you to be a millionaire,
Right.
right? And so, I learned that at an early age, and I grew up with a single mom, so I didn't have anyone teaching me. I literally fell flat on my face in my mid-20s. I owned about like eight, I think eight at one time, 8 two-families, and lost them all because I was trying to wear different hats all the time. And, the market crashed. That wasn't in my favor either. But at that point I said, you know what am I doing? Like, why is it that I'm making money with mortgages? And then I'm like, oh, let me go try this out. Why? Hyper focus on this. And you'll turn around in a year or two and say, I got $500,000 in the bank. What am I going to do with it? I don't know. Maybe I'll go buy a couple properties. Maybe I won't. Maybe I'll open up some indirected IRAs that pay me out in 15 years instead.
It's just so interesting to see that it's instead of like property management, it goes straight into like partnerships.
Mhm.
Like, like is it more, or I guess what I was going at was, it more costly or like as a partnership versus just hiring a property manager?
Well, a partnership is going to care more. Right. A property manager is not going to care as much. So if you came to me with a good deal and say, Mike, I got a 4-family house, you put down 30, you put down 15%, I'm going to put down 15%. And this is the return. You're going to get 8% on your money, but you never have to come to the property. I would take that any day of the week and twice on Sunday, because that's true passive.
That is.
That's why one of my dreams, fast forward, you guys ask me what I want to be later on. One of my dreams is, not dreams, but one of the realities that I'm really going to make happen is I want to be a hard money lender. I like lending money with interest. I think it's great, and at the same time, you're kind of partners in the property too, because you're putting a lien on the property.
And I like how you said one of my dreams, and you said instead, one of my realities, that's going to be little things like that.
Dreaming's not for guys like us, right? We don't dream. We make it happen. I could tell. We all could tell about each other. We make it happen.
Just like that.
I don't want to cut short. I got to run now. I'm going to let Austin finish up the podcast.
Yeah. So the second question is, what was your favorite business or personal development book?
So, Jonathan told me you were going to ask me that question, and I'm going to be totally transparent. I don't read books. I read every day. I love reading. I read every day. I read my business. I read I read about my craft. I read FHA guidelines. I read about interest rates every day. I read every day about economic news, because that's what can affect my clientele. In regards to reading books, I love the book, The Secret. I love things that have to do with energy and law of attraction. I'm not like, big meditator or anything like that. I don't sing Kumbaya or anything like that, but I really do, man. I feel like energy says a lot, man. Like, me and you don't know each other, but I could tell that we're going to get along. You got the same energy. We're looking at things in a positive way. We don't look at the cup. How does that saying go? Look at the glass half filled, it's half full, right?
Right.
So, yeah, books about motivation and about law of attraction is what I'm into. And a lot of people ask me that question. They're like, oh, man, what books can you recommend? And I'm like, I don't really read books.
don't read books.
The
I
funny
read
part
them.
about it is that you would go farther. Well, here's what I say. Like a lot of people, you know, they'll read the books just for like the head high, right? Of reading the book and you're like, you can imagine yourself in that like scenario, right? And reading the book and not taking action is almost as the same thing as like being illiterate and just taking, you know, and but being able to take action. And a lot of the things that you can learn just by like being in the environment of people that are doing what you want to do on a successful note, you'll learn like more than enough from them than what you could from a book without actually applying it. Like for anybody that's reading books and applying it right away, different story. But, you know, a lot of people, which is, you know, I did that in the very beginning where I was reading a lot of books, just not taking enough action. It helped me change my mentality about what was possible, especially going from a salary to a W, like, you know, to 1099 where you're independent and everything's up to you. But I saw the more value of it when I just read one book, read it chapter by chapter, and actually implemented like whatever chapter that it was. So more results just from one book, just choosing one book instead of just having a bunch to read. So
I would actually ask you, Austin. I mean, if you can recommend some books that.
oh man, man,
like
depending on here's the thing. Miracle Morning was one of those books where, because, you know, we can give you a bunch of real estate books and all this other books. Like, you know, you can find a bunch of articles and all that. So it's out there. The information is definitely out there. Miracle Morning, though, was one of those books where it just puts you in the proper mindset to be ready to receive and change your life.
the miracle.
Right?
The miracle. Wait a minute. Somebody gave me that. The miracle.
Miracle Morning by Hal Elrod.
Yes, that's the one about waking up early.
Not so much waking up early per se, waking up more intentional.
Intentional.
Right? So like a lot of people, you know, you can, I mean, of course, like anybody that's getting up at 4:30 or 5, like absolutely, but more so about just putting yourself in the proper mindset where, put it like this, here is the whole entire synopsis. Most people get up and you go straight to work. Like the first thing that they're doing the moment that you wake up is basically getting ready for work. So you're getting breakfast because you got to eat for work. You're dropping the kids off, getting ready for work. You're doing this and then like showering, clothes, and getting ready for work. Like everything, like by the time that you wake up, you already have this deadline in your head of like, all right, I got to have all these things done before I go to work. Where Miracle Morning is just like, all right, work's going to be there. Let's handle us, right? Like let's handle us. And then once we go to work, we're going to handle our work so profound and so efficiently that, you know, it's actually better for us productive wise to handle like that. But do you have to follow that routine? Or it's not so much a routine, like they give you a routine to follow, but it's just about putting yourself first. You know what I mean? Like a lot of times, like we, you know, especially in this business where you're in the service-based business, it's real easy to get up and then worry about everybody else's stuff except for you and your family. So it helps you get centered because, you know, life is bigger, you know, take it the right way, but life is bigger than this current transaction that's going on right now. Where do I, you know, yes, I want to help every single person that I'm working with now, but my spirit inside also wants to help the 500 people that I'm going to eventually help as well. I got to work on that mind frame so I can do that as well. You know what I mean? So, but that was the Miracle Morning, you know, but that's that book in a nutshell.
All right. Well, that's good to know, man. And that sounds it. See, things like that, like, you know, sometimes it's like you say, I get up with an intention. I get up very happy every morning. I'm ready to go. You know, I sit down, I do my shake. I take care of me first. You know, if I do some cardiovascular, you know, I get my mind right.
Yeah.
But a book can help you stay consistent to that. Because let's face it, I might be consistent 2 days in a row. And then just like that, the next day I'm like, oh, I got to do this. I got to do that.
Right.
And you're absolutely right, Austin. You wake up like that, your whole day is just foggy. And you're like, what's going on with me today? How come I'm not feeling it? And we wonder why. It's because we didn't wake up with intention.
That's all it is. It's just waking up, just getting silent. Same way where you're exercising, you know, getting some things going. You know, it's the same exact thing. Whatever it is, just having a morning routine. That's it. Whatever that morning routine is. Same way like a free throw shooter, a batter, you know, whatever the case, they have a routine. They do it all the time. Every time you see Steph Curry, you know, score a three, He does the, straight up, he points up. Whatever that routine is, there's a reason why that routine, and I say, I heard it's like, has nothing to do, it's the routine, it's less so much about the routine, like what you actually do with the routine. It's more of the mental triggering of your mind to get into a concentration mode. Right. So every time like somebody's at the free throw line, if they don't do their morning routine, or not morning routine, LeBron James is at the free throw line, he does his normal, routine. Everybody has their regular free throw routine. Is LeBron not capable enough that if he were to not do that morning routine, can he not make the free throw? Of course he can. He can do that. But it's just getting your mind in the most peak optimal where you don't have to worry about missing because it's going in because you did your routine. So it's just the mindset aspect of it. So I don't care if your routine is to get up and, I don't know, go whatever the case. If as long as it's for you and you're taking care of you, then you'll be able to take care of everybody else just so smoothly and just so more efficiently. So that's what that book is. So yeah, last two questions here. When you're not out lending, helping people go into their new homes, helping first-time home buyers achieve their goal, achieve their dream, what are some of the fun things that you like to do in the spare time?
Yeah, so definitely like fitness. I love fitness. Love staying in shape. And my son now is 14, so he's becoming a part of the fitness, and he's a teenager, so I'm hanging out with him more. I didn't grow up with a dad, so for me it's really important that I play that role and I play that solid role for him. I work a lot Monday through Friday from 9 to 9, so when I'm not doing that on the weekends, I'm a homebody, man, to be honest with you. Homebody and doing normal things, not doing anything extravagant, taking a walk around the neighborhood or playing basketball with my son. We do that pretty much every weekend. So when I'm not doing mortgages, I'm just a regular family guy.
I love it, man, because this it's a really fast-paced business, and you don't value the like just solitude or just the quiet time until you're in like a fast-paced business like we are. So I definitely feel you on that. And question number 4, last but not least, Mike, where can people find you at if they want to learn more about the mortgages, learn more about the branch? Maybe they're thinking about becoming a mortgage officer themselves. Where can people find you at?
Yeah, so Instagram, Mike Mortgage, right? You can find me Mike Mortgage on Instagram. You go to my website, michaelmortgage.com, michaelmortgage.com. And I always say the best is, believe it or not, my cell number. I've had the same cell number since 1998. So
Well, let us have it. What is it?
Or 908-296-6608. That's area code 908-296-6608. Best way to get in touch with me.
Yeah, I appreciate that. I know, and I always say like I try to get the bulk of the which we did, but I know just when you go into good conversations, a lot of scenarios, a lot of variables, because there's just a lot when it comes down to the lending and the mortgage side, and I know it can be scary for people. So tried our best to break it down, which you were really helpful, just breaking down the different concepts just individually and really digging into it so just people understand, especially with providing analogies, because this business can be complex for people that are not in it 24/7, and just helping to break it down. And to your point, considering the fact that I know even earlier today that you mentioned that you were working with an individual that wasn't qualified, you stay with them an extra 30 minutes. Same way in this case where this episode was only supposed to maybe be about 30 minutes. And here we are, and we're in some change later, but with all the gold and with all the gems. So obviously, as the listeners can attest, you are about your word, considering the fact that you're still on this podcast way after when we were supposed to finish it. But it's all within in good character, and it's all within good content. So I appreciate it. Definitely for coming on the show. Thanks for sharing the wisdom. I greatly appreciate it, Mike.
I appreciate you, Austin. Thank you very much. And I'd love to be on again. You let me know.
We'll obviously be in touch. We got more work to do, especially, because I'm basically working with you vicariously through Jonathan, you know what I mean? So obviously we'll keep business and good business going forward. We'll just continue to get deals done and continue to serve our clients. That simple.
Thank you.
Thanks, Mike.
Thanks, man. Take care.